In this chapter, we'll be discussing about debt to GDP ratio. So, debt to GDP ratio is the ratio between a country's government debt, cumulative amount, and the GDP measured in years. Okay. So, a low debt to GDP ratio indicates that the country can pay back debts without incurring further debt. So, you have to interpret the ratio like this. If all of the GDP is used to pay off debt, then how many years will it take to clear off the country's outstanding debt? That is what this ratio indicates. So, for example, debt to GDP ratio 70% means the country's debt is so much that it will take 70% of the country's annual GDP to pay off. However, please note that repayment of government debt is not like a credit card payment where we can pay off entire outstanding. Okay, we do that because we have to pay interest on the unpaid portion, but governments cannot do that. Government cannot spend all the GDP for debt repayment because it needs funds for other purposes also. So, in practice, only 5 to 10% will be spent on debt repayment. So, just like individuals and companies are rated by rating agencies like CIBIL, governments also rated by rating agencies, and debt to GDP ratio is one of the ratios they use for rating governments. So, high ratio is not bad if economy is growing because the country will be generating income in future to pay off the debt, and as the debt gets repaid, the ratio will improve. So, in India, for many years, government used to the fiscal deficit parameter as the control parameter, but since the new government in 2014, it started focusing more on the debt to GDP ratio rather than fiscal deficit. That was based on recommendation by an expert panel. So, the target ratio is the combined debt to GDP ratio combined for both central and state governments is 60% by 2023. That is the target. That's 40% for central government and 20% for state governments. The committee has also recommended 3% fiscal deficit for the next 3 years. That is also the fiscal deficit target which the government is aiming at. So, in this chapter, the questions need to be prepared are: what is meant by debt to GDP ratio? What does a low debt to GDP ratio indicate? What is the interpretation of this ratio, and what is debt to GDP ratio that Indian government is targeting? That is 60% by 2023.